Discover the tips and strategies that will help you achieve your retirement goals. I'm your host, James Knoll, and this is the podcast dedicated to helping you retire well. It all starts right here on Ready for Retirement. Hi everyone, and welcome back to another episode of Ready for Retirement. I'm your host, James Knoll. Today we're going to be talking about the Secure Act 2.0. Now, if you're not aware, there was a giant spending bill that was passed at the end of 2022, and part of this was the Secure Act. Now, the Secure Act particularly pertains to retirement and trying to allow some provisions to make retirement more accessible and even easier for people to begin planning for. Now, many of these bills pass, and it maybe only impacts a certain group of people, or maybe it's a very small change. This is not that bill. This bill has sweeping changes that have lots of impact to different people. So not only do I want to walk through what were those provisions in the Secure Act 2.0, but I want to talk very specifically about how can this change the way you do your planning so that you can make the most of your financial future. So quick reminder before we jump in today, if you've not already done so, please leave a review for the podcast if you've enjoyed this content. We're getting over 30,000 downloads every single month, which means a lot of people are getting access to great information of how they can better their future and better their retirement plans. And that only happens by more and more people becoming aware of this show. So by you telling your friends or by you leaving reviews, it helps more people get access to quality content so that they can have a more secure future. So really appreciate those of you who do leave reviews. It really does mean a lot to me. It does allow more people to find the show. If you haven't done so already, would really appreciate that. So with that being said, let's jump in. And disclaimer before we do this, anytime huge bills like this pass, there's always some uncertainty. There's always some uncertainty with regards to the way a certain phrase was worded and what does that mean in terms of who's eligible or not eligible. There's always some changes that come about or some clarification that comes about. So as we're looking at this, a lot of this is set in stone. A lot of this is already just established as of January 1st of this year, but some of this is still not fully certain. There's still some uncertainties around it, and so I'm going to do my best to point that out as we go through this. But before you make any changes, and this disclaimer kind of goes with everything, but check with your financial advisor, check with your tax advisor, because some of these things are a little bit nuanced in terms of how they're worded or the specific application of some of these things. Also, there is a ton in this bill. There's a lot of new provisions. I'm not going to go through every single one because we don't have days and days and days on this podcast to get through it. Instead, I'm going to highlight the most important aspects, at least as I see it, as it pertains to what's going to be the most relevant to the most number of people. To start with, let's highlight what this is coming on the heels of. So this is called Secure Act 2.0, which implies that there was an original Secure Act, and there was. Back in 2019, the original Secure Act passed, and there was some changes to it. Now, some of these changes were a lot more impactful, but there was a lesser number of changes. The big changes was that original Secure Act pushed the RMD age from 70 and a half to age 72. There was an expansion of 529 plans to cover secondary education as well as higher education, so college and above. It eliminated stretch IRAs. This was one of the big impacts of the original Secure Act, where instead of being able to take RMDs from an inherited IRA over the course of your lifetime, you now have to fully distribute any IRA or Roth IRA or retirement balance within 10 years with a few exceptions. But that was a change that went into effect for any retirement plans that were inherited on January 1st of 2020 or beyond. And then there's also a number of things like offering credits to employers to set up 401k plans, offering credits to add automatic enrollment to these 401k plans. But that was the majority, again, at least in terms of what impacted the most number of people. Now, Secure Act 2.0, a lot more provisions coming from this. To start, required minimum distributions had some changes. I just mentioned that in 2019, the original Secure Act pushed the RMD age from age 70 and a half to age 72. Well, this new Secure Act, it pushes the RMD age to age 73. And for those who were born in 1960 or later, it pushes it to age 75. Now, why does Congress do this? Why doesn't Congress just make it simple and say, here's a new RMD age regardless of when you were born? Well, when Congress rolls out these plans, they want to show how the program will be funded. So they could factor 2 more years of RMDs into their projections or into projections of future tax revenue by holding off on pushing the ages to 75 for a number of years. So with this, depending on how old you are, what year you were born, you may have 3 different potential RMD ages. To simplify it, if you were born in 1950 or earlier, your RMDs start at age 72. Now, they could potentially be even earlier if you turned age 70 and a half prior to 2020, but for the sake of simplicity, if you were born in 1950 or earlier, your RMDs will stay at age 72. If you were born between 1950 and 1959, your RMD age will be age 73. So for that decade, if you're born anytime in the 1950s, your RMD age, the age at which you have to start taking funds from your IRA or pre-tax qualified retirement accounts, that begins at age 73. And if you were born in 1960 or later, your required minimum age at which you have to start taking these required distributions is age 75. Now, qualified charitable distributions, which we're going to touch upon a bit later in the episode, those can still be taken at age 70 and a half, which is a nice benefit. Again, I'm going to touch upon that later, but RMD ages have shifted back. What are the planning takeaways from this? Well, what this will allow for is it will allow you to push off taking retirement account income for either 1 or 3 more years, depending upon your date of birth, which one helps to push off Medicare Part B and Part D premiums, or higher Medicare Part B and Part D premiums if your income's over a certain threshold. But 2, this gives you 1 to 3 more years of the ability to make tax-efficient Roth conversions before RMDs go up. I oftentimes talk about a tax planning window. And the tax planning window usually starts the day that you retire or the year that you retire, and usually ends when required minimum distributions begin. And if you can envision this, in your working years, you have a much higher income. And then in your RMD years, depending, of course, on the size of your traditional IRA, you may also have a much higher income. But between those 2 points, that's your tax planning window. It's kind of like the valley where for most people, or for a lot of people at least, there's going to be lower income. Maybe because Social Security hasn't started or RMDs haven't started. You have this valley, you have this window, and in this window, that's when it oftentimes makes the most sense to implement Roth conversions. The specific amount, of course, depends upon your strategy and your situation. But what this is doing, by RMDs being pushed back to either age 73 or age 75, it's extending that window, which means number 1, you either have more years that you can process these conversions to save on taxes, or number 2, you don't have to cram so much of these conversions into any specific year because that window has expanded. If you have a goal for how much you want to convert from your traditional IRA to your Roth IRA, well, now instead of having to cram that all into a limited number of years, you have 1 to 3 more years that can be spread out over. So in a way, it maybe means you can pay less taxes on your conversion by not converting as much each year, but still converting the same overall amount because you have a longer window with which you can implement this. In fact, leading up to the passage of Secure Act 2.0 this past year, meaning 2022, for a lot of clients, I was actually encouraging lesser Roth conversions than we would actually typically do because of this anticipation of RMD ages being pushed back. So what I wanted to avoid was people converting too much in any given year because they felt that their window was closing and they only had so many more years that they could do this before RMDs kick in. And that's working out nicely because now we can spread those conversions to other years, meaning we're not paying as much in taxes in this year or next year because we can get the same job done without the same annual tax hit or the same annual tax burden that we otherwise would have faced. So that is a nice change as part of this bill. Some other changes that came along with this bill had to do with Roth accounts. Now, to start, there's some things that it did do with Roth accounts, and equally important, there's some things that it didn't do. Let's start with what it didn't do. It did not eliminate backdoor Roth conversions. Now, early in 2022, there was a lot of concern of, okay, this original provision or original bill, it would have done away with your ability to convert after-tax contributions to an IRA into a Roth IRA. The implications of this? You could not do a backdoor Roth IRA or a mega backdoor Roth 401k contribution through your employer. Now, that provision was ultimately taken out of the final bill. So if you're someone who makes too much money to contribute to a Roth IRA, or if you're someone who's been doing the mega backdoor Roth contributions through your 401k at work, The good news is you still have the ability to do that. At times, there was concern that that was going to be eliminated, but the good news is that still exists. Now, what did this bill do with regards to Roth? Well, for starters, it created simple Roth IRAs and SEP Roth IRAs. Now, anytime I say simple, people automatically think that, okay, it's like simple and then complicated. No, simple is actually an abbreviation. It's like a 401k or a SEP IRA, where it's a type of retirement account. But previously, so previous to this bill, if you wanted to set up a simple IRA or if you wanted to set up a SEP IRA, you only had the ability to do that with pre-tax contributions. So for example, for 2023, you can contribute up to $15,500 to a simple IRA. There's also a catch-up contribution on top of that, but prior to this year, that could only have been a pre-tax contribution. So if you're self-employed and you've set up a simple IRA, but you want the ability to do Roth contributions, you didn't have that before. You would have to do a Roth IRA or potentially set up a Roth 401k, but that comes with another set of requirements that sometimes people didn't want to have to deal with. So to me, this is a great change. It's going to allow more people to get more money into Roth accounts if they choose to do so, specifically self-employed people, by not limiting you to either a Roth IRA, which has fairly low contribution limits, or a Roth 401k, but you're kind of dependent upon your employer to be able to offer that in the plan. So technically, you can set up a simple Roth IRA now or a SEP Roth IRA now. Those went into effect on January 1st of 2023. The reality is, though, that you have a custodian. Custodians like a TD Ameritrade or a Charles Schwab. Those custodians need to create the necessary documents and the procedures that will allow you to set up these accounts. So the actual implementation of this might not come immediately. In fact, it's not going to be here today or on January 1st of 2023, but it will likely come throughout this year. So there is almost a theme in the Secure Act 2.0 of allowing and expanding access to Roth accounts. And that ties into the next provision that I want to talk about, which is the ability to shift funds from a 529 plan, so a college savings plan, to a Roth IRA for that 529 plan beneficiary. This is a big one. So beginning in 2024, this will allow for some individuals to move money that's in a 529 plan directly into a Roth IRA for that same beneficiary. There are rules. People are getting very excited about this, but not enough people know the exact rules of how this needs to work. The first rule is this: the Roth IRA receiving the funds must be in the name of the beneficiary of the 529 plan. So for example, I have a 529 plan for my daughter. If I set that 529 plan up and she doesn't end up using those funds, I can't transfer those 529 balances to my Roth IRA. I could only transfer them to hers or vice versa. Now, there is some confusion around, can I simply change the beneficiary of the 529 plan and make some allowances for this? Not clear yet. That's to be determined. But the Roth IRA receiving the funds must be in the name of the beneficiary of the 529 plan. Second rule, the 529 plan must have been maintained for 15 years or longer. So a lot of people hearing this saying, oh my gosh, awesome. I'm just going to set up a 529 plan, load up a bunch of money in there, and then immediately transfer to the beneficiaries on file. Well, that's not going to be allowed. You have to have had the 529 plan maintained for 15 years or longer. Now, you don't have to have a ton of money in the 529 plan for 15 years. Even if it's just funded with, say, $100, that counts as being funded. The second, kind of the tag-along rule to this, is any contributions to the 529 plan within the last 5 years, as well as any earnings on those contributions, those are ineligible to be moved to the Roth IRA. So if I go back to my example, maybe someone put $100 into a 529 plan 15 years ago. They say, okay, great. Well, now can I put a bunch of money in the 529 plan today and then start transferring that to my child's Roth IRA? No, you still have to wait 5 years from the time those actual funds were contributed to be able to transfer those specific funds into your child or grandchild or whoever it is, the beneficiary's Roth IRA. Another rule is the annual limit for how much can be moved from a 529 plan to a Roth IRA is still going to be the IRA contribution limit for a year. So the total that can be contributed is $35,000. Probably should have started with that aspect of the rule. What this rule states is that the max that can be moved from a 529 plan to a Roth IRA during an individual's lifetime is $35,000. However, you can't do that all in 1 year. You can only do up to the annual Roth IRA contribution limit. So to use easy numbers, let's assume that the Roth IRA contribution limit is $7,000 per year. Now for 2023, it's actually $6,500 if you're under 50, but let's just use that as $7,000 to keep this math super simple. If it was $7,000 for the next 5 years, and I have a 529 plan for my daughter, and maybe she's not going to use it for college, and I've maintained it for 15 years, I could move $7,000 this year from the 529 plan to the Roth, $7,000 the next year, $7,000 the next year, and then the same for the fourth and the fifth year, where after 5 years of $7,000 transfers, I have moved a total of $35,000 into her Roth IRA. That's the lifetime cap. If I still have money in the 529 plan, I'd have to find something else to do with it, either transfer it to another beneficiary, take a withdrawal, do something different. But $35,000 is the annual cap, and it is still subject to the annual contribution limit, and it counts towards that. Meaning I couldn't do $7,000 from the Roth IRA, or I should say $7,000 from the 529 to the Roth IRA, and then my daughter does another $7,000 of her own contributions. That would be doubling up. I can only do one or the other, and the total contribution cannot exceed the contribution limit for the year. And then another rule along with this is that the transfer rules do require that the child has some compensation. So in the same way that if someone wants to make a Roth IRA contribution today, they have to have compensation. They have to have wages. You can't make a Roth IRA for most children because that child doesn't actually have wages. Well, same rules apply to 529 plans. If you started a 529 plan the day that your child was born, and now you say, great, the day they turn 15, I'm going to move those funds into their Roth IRA. Well, unless they've got some income, you're not going to be able to do so. So not only are you subject to the annual contribution limit, but your child must show some income. Now, here's some planning points with this. Number one, the biggest one, is most parents' concern when they're putting money into a 529 plan for college is, what if my child doesn't use this? What if they don't go to college? Or what if they get a scholarship? Or what if I overfund this? Well, the good news is this is giving you a pretty significant fallback. You can just turn this in to seed money for your child's retirement planning. So this is money that will grow completely tax-free for them for the rest of their life. So overall, this is going to make it a lot more appealing for parents to be putting money into a 529 plan because there's not that sense of, oh my gosh, what if they don't go to college and the penalties and taxes, et cetera, et cetera. This is a really nice fallback, maybe even potentially better fallback for some people to be able to redirect these into Roth savings if that college doesn't materialize or if higher education doesn't cost as much as you maybe have set aside in a 529 plan. Number two, the second big planning point here is transfers from a 529 plan to a Roth IRA in the name of the beneficiary of the 529 plan. They're not subject to the same income limits that Roth IRA contribution limits are. So if you have excess funds in a 529 plan and the beneficiary of that 529 plan is now working and they're out of college, and maybe they're working a great job and they're earning too much to actually contribute to a Roth IRA, that won't impact their ability to have funds from their 529 plan transferred to their Roth IRA. So that's a really nice benefit here, is that the traditional contribution limits for Roth IRAs don't actually apply. Now, kind of a secondary planning point with this is, and this is where there's some fuzzy language around it, but for some parents, maybe they fully funded their kids' college and they say, you know what, I would love to use these 529 plans to fund my retirement. Maybe I was so focused on college planning that I didn't put enough away for my retirement. Well, could you change the beneficiary on your 529 plan to yourself, which there's no issue doing that from the 529 plan rules, and then could you simply move those funds into your Roth IRA? Maybe you're earning too much to contribute directly to a Roth, but is this almost a workaround or another way of getting funds into your Roth IRA, even if your income is too high? Again, this is one of those things where the language is a little fuzzy, and there is the rule of you need 15 years of the account being funded. But could you simply change the beneficiary to yourself, or would that trigger a new 15-year time frame for when you could actually access those funds? It's a bit unclear, but that's a planning point that we're going to wait and see how that unfolds. Another new provision of Secure Act 2.0 has to do with new beneficiary options for surviving spouses on retirement accounts. This rule doesn't actually go into effect until 2024. Here's how it works though. Under this new provision, RMDs for a surviving spouse will be delayed until the deceased spouse would have reached the age at which RMDs begin. Okay, now you're probably thinking, what on earth did James just say? That makes no sense. Let's use an example to actually flesh out how this will work and then summarize the principle of it. Let's assume you are 65 years old and your spouse is 60. Now let's assume that tragically your 60-year-old spouse passes away and they had a traditional IRA. Now, previously, under old rules, when you inherit that IRA, you could simply elect the option to have that become your own IRA. So your 60-year-old spouse passes away, you as a 65-year-old make that IRA your own. Now, under that, your RMDs would start at age 73. So again, normal rules, that just got pushed back. Your RMD age would be age 73. The new rule gives you this as an option. It says you can instead elect to be treated as your spouse. So in other words, with your deceased spouse's IRA, you could you could elect to be them, which does two things for you. Number one, there's a 5-year age gap there, which means that you're not taking RMDs based on your age, you are taking RMDs based upon the age they would have been. So in this example, you're 65, they are 60. That gives you 5 more years on their RMD, or on their IRA, I should say, until you have to take an RMD. So it buys you more time, and I believe, and this isn't entirely clear from what I read, but I believe from the language I'm looking at, not only would this give you the extra 5 years from the 5-year age gap, but it would also give you 2 additional years in this specific example, because your deceased spouse wouldn't be subject to RMDs at age 73. Because of their age, they would instead be subject to them at age 75. So based upon that, that buys you 7 more years with their IRA until required distributions kick in. So this is just a new beneficiary election for how you can elect to treat the retirement plan of a deceased spouse. The basic principle, just to put it nice and concise, is if you have a younger spouse that predeceases you, it will likely make more sense to take that option as opposed to making that IRA your own. If you have an older spouse and that spouse predeceases you, you probably wouldn't want to elect that because you would then be subject to RMD rules that are actually further ahead based upon IRS life expectancy tables. So that will be an interesting planning point when there are age gaps between spouses in retirement. Another new provision from the Secure Act 2.0 bill is it changes the IRA Catch-Up Contributions. So prior to Secure Act 2.0 being passed, the ability or the amount that you could make in IRA catch-up contributions, it was not indexed to inflation. So since 2006, the IRA catch-up contribution limit has been a fixed $1,000. Well, going forward, that's going to be indexed for inflation in increments of $100. So the planning points around that, number one, you'll start to have the ability to contribute more to an IRA or Roth IRA, subject, of course, to the same income limits. Number two, though, you might have to start tracking odd contribution limits. Typically, contribution limits are $7,000 or $7,500, something kind of like a round number. Now it might be $8,300 or $9,400 after a number of years of adjusting for inflation. So just kind of odd contribution limits, but the good news is those limits will be higher than they've been in the past. Another provision having to do with contributions is Secure Act 2.0 changes the way that catch-up contributions are calculated with regards to retirement plans through work. Now, there's a few different ways that this is happening. Number one, employers will now be permitted to deposit the matching and or non-elective contributions to an employee's Roth account as opposed to their pre-tax account. As of now, all employer matching goes to pre-tax accounts. So if you're doing a Roth 401k, and let's assume you get a 3% match for whatever you put in your 401k. Well, if you're doing 3% to your Roth, your employer is still going to do 3% to your pre-tax account. One of the changes in this new provision is you can elect for your employer to make Roth contributions instead. Now, there's no free lunch here. You're not just getting free dollars into your Roth IRA. You are paying the taxes for it. So in the past, if you got that 3% contribution to your pre-tax account, you didn't pay any taxes on that. It didn't show up on your wages. It just went in pre-tax. Now, if you were to elect that 3% to go to your Roth 401k instead of pre-tax, it would show up as wages on your wage statement. So you're paying taxes on it, but now you have the ability to get more money into Roth accounts. Also, starting in 2024, so what they're doing is they're giving a year for companies and plan sponsors to adjust for this new provision. But starting in 2024, anyone whose wages were more than $145,000 from their employer in the previous calendar year has to have their catch-up contribution put into their Roth 401k. So this is one of those things that you look at and you see how Congress did this to project more tax revenue to offset the other costs of the program. But what it's saying is higher income earners, you can still save, you can still do the catch-up contribution, but not on a pre-tax basis. So this year for 2023, for example, the catch-up contribution to a 401k is $7,500. This year for 2023, that $7,500 would go into a pre-tax account. In the future, starting in 2024, you won't have that option anymore. That $7,500 will go into the Roth account, meaning you will pay taxes on it today, but then it will continue growing on a tax-free basis. So that's starting in 2024, and starting in 2025, 401k catch-up contribution limits will go up even more. So for 2023, as I mentioned, the catch-up contribution limit for 401ks and other employer-sponsored retirement plans is $7,500. In 2025 and beyond, the limit will become $10,000 or 150% of normal catch-up limits for those who are 60 or older. So for example, if you're 60 years old today in 2023, your catch-up contribution to your 401k for 2023 is $7,500. Starting in 2025, though, that catch-up contribution would go up to at least $10,000. So jump from $7,500 to $10,000. But the confusing thing to me about this is Congress says the new catch-up contribution limit will be either $10,000 or 150% of the current catch-up contribution limit. Here's why that's confusing. The current limit is already $7,500 for 2023. 150% of that is $11,250. So we're already higher than the $10,000. So I don't even know why Congress included that $10,000 as one of the deciding factors of what your contribution limit is going to be. But for now, that's what it is. But as we're looking at this, starting in 2025, catch-up contribution limits will go up even more for those of you who are 60 or older. So that will be a big change. The planning implication, of course, is the ability to contribute more to your 401k. The other implication is forced contributions to Roth accounts. So if you're trying to make the decision of should I do Roth, should I do pre-tax? Well, with your normal contribution limit, which for 2023 is $22,500, you can choose whether you want to put those funds into your pre-tax 401k or into a Roth 401k. But any catch-up contributions, you don't have that choice if your income's over a certain threshold, and that threshold is $145,000 adjusted for inflation. That will have to go into the Roth account. So planning points there, but some of these provisions won't take effect until 2024, and some won't take effect until 2025. All right, just a couple more provisions that I want to point out that I see as being very impactful for a lot of people. One is around qualified charitable distributions. So as of today, qualified charitable distributions are limited to $100,000 per person. So if you're married, you can each do $100,000. Well, that $100,000 limit was started more than 15 years ago, and it was also $100,000 at that time. So what they're going to change going forward is that will now be linked to inflation, which means you can do more and more each year as a qualified charitable distribution. Another planning point is there's a reduction of penalties for missed required minimum distributions. Now, this one's actually pretty important because the penalty for a missed RMD is one of the most severe penalties that exists. The penalty before was 50% of any RMD balance that wasn't taken. So for example, let's assume your RMD for 2022 was $40,000, and for whatever reason you didn't take it. Well, you catch that and you realize, oh shoot, I didn't take that. Now what you have to do is you have to take it, so $40,000. You owe the IRS a $20,000 penalty for not taking that on time, and you still have to take it and still pay taxes on it. So let's assume you're in the combined 30% tax bracket. What that means is on a $40,000 distribution, you would owe $12,000 in taxes plus a $20,000 penalty. So you effectively had an 80% tax on that RMD, which is the $32,000 you paid in taxes and penalties, divided by the $40,000 distribution. So effective for 2023 and future years, the new Secure Act 2.0 reduces the 50% penalty for an RMD shortfall to 25%. If, though, the shortfall is rectified within what's called the correction window, then the penalty is reduced to 10%. The correction window starts the day that you effectively missed it. So for 2022, the correction window would start January 1st of 2023, and it would end when either you received a notice of deficiency that was mailed to you, or when the tax was assessed by the IRS, or on the last day of the second tax year after the tax is imposed. So this is what's listed as the end of the correction window. Bottom line, don't miss an RMD, but if you do, the penalties are still fairly high. 25% still a really high penalty, 10% still a high penalty, but it's less than it was before at 50%. Why is this a planning opportunity? Well, you never want to miss an RMD, but RMDs can be confusing. I see it when people have multiple accounts and they don't properly account for all their different IRAs when calculating their RMD. I see it when people just miscalculate the RMD amount. Maybe they plugged a wrong number into the calculator they're using, or whatever happened, they just take the wrong amount. Maybe they couldn't get funds out by year end. They didn't have a bank account linked to their IRA. And by the time that they linked the bank account and processing happened, it was too late. Or I see a lot of people that just aren't familiar with the rule. The IRS isn't going to call you and say, hey, James, just a friendly reminder to take out your RMD by the end of the year. That's not going to happen. It's on you. And if you have a financial advisor, then hopefully they're helping you to determine what needs to be taken and the timing of that. But it's on you to do this. And I see far too many people who don't just miss RMDs, but have multiple years of missed RMDs because they weren't familiar with the rule or have simply been miscalculating the whole time. So as we're looking at this is absolutely not all the provisions of Secure Act 2.0. But as we're already going on over 30 minutes of this episode, wanted to keep it to the most important provisions as I see it. Final word on this is be mindful of the dates. Some of these provisions take effect now, meaning 2023. Some take effect in 2024, some in 2025, and some, like pushing of RMDs till age 75, that doesn't take effect until 2033. So be mindful of this. Not everything I said today is applicable today. So make sure you know the time frame for each of these, and also understand the language is somewhat contradictory in some areas or even ambiguous in some areas. So anytime significant new legislation with all these pages and provisions and things included in it, when it gets pushed through, expect for Congress to try to attempt to clarify or modify some of these areas. There's just some language that's ambiguous and we can expect more clarification, but some of that might not come for several months or even years in some cases. Always talk with your financial advisor or accountant to see how these changes will impact you in your specific situation, because as with everything in planning, anything you do with regards to one aspect of your finances invariably impacts other areas as well. So make sure you have a thorough understanding before you go implement some of these changes or before you try to abide by some of these changes to make sure you're doing it correctly. If you don't have a financial advisor and you're looking for one, well, reach out to us at Root Financial. It's exactly what we do. You can go to rootfinancialpartners.com, click on Start Here, and one of our advisors would love to chat with you. With that being said, though, thank you for taking the time to tune into this. Really important provisions here coming out from Secure Act 2.0. I hope that was helpful as you're looking at your planning circumstances. And as always, I appreciate you tuning in to another episode of Ready for Retirement. Thank you for listening to another episode of the Ready for Retirement podcast. If you're looking to work with a financial advisor that cares deeply about helping you get the most out of life with your money, head over to our website at rootfinancialpartners.com and click Start Here. One of our advisors would love the opportunity to speak with you. You can also find the show notes for today's episode on our website, along with other great content that will help you to create a wonderful retirement. And finally, if you have a question that you'd like for me to answer on a future episode, then from our website, click on the Learn tab. Scroll down just a bit on that page and then click Submit a Question to submit a question that I will answer in a future episode. Again, that can all be found at rootfinancialpartners.com. Thanks as always for listening, and I'll see you next time. Hey everyone, it's me again for the disclaimer. Please be smart about this. Before doing anything, please be sure to consult with your tax planner or financial planner. Nothing in this podcast should be construed as investment, tax, legal, or other financial advice. It is for informational purposes only.